Question 1. A life insurance policy sold in California must include a provision allowing the policy owner to return the policy for a full refund within a specific timeframe after delivery. What is this provision commonly known as? A. The grace period. B. The Incontestability Clause. C. The free look period. D. The Reinstatement Clause. Answer: C. The free look period. The free look period, also known as the right to examine period, is a mandatory provision in California life insurance policies that allows the policy owner to review the policy and return it for a full refund if they are not satisfied. This provision typically grants a minimum of 10 days, but for policies sold to seniors, age 60 or older, it extends to 30 days, providing an important consumer protection. For example, if a policy is delivered on June 1st and the policy owner decides on June 8th that it's not suitable, they can return it for all premiums paid. Always remember this crucial period protects consumers from making hasty decisions. Question 2. Under what circumstances can a life insurance policy be rescinded by the insurer due to a material misrepresentation by the applicant, according to California law? A. At any time, as long as the misrepresentation is discovered. B. Only if the misrepresentation was intentional and fraudulent. C. Within 2 years from the policy's issue date, regardless of intent, if material to the acceptance of the risk. D. After the policy has been in force for 2 years, only if the misrepresentation was about age or gender. Answer: C. Within 2 years from the policy's issue date, regardless of intent, if material to the acceptance of the risk. The Incontestability Clause in California life insurance policies generally prevents an insurer from denying a claim due to material misrepresentations in the application after the policy has been in force for 2 years from its issue date. However, during this initial 2-year contestable period, the insurer can rescind the policy if they discover a material misrepresentation, even if it was unintentional, provided it affected their decision to issue the policy. For instance, if an applicant failed to disclose a serious medical condition and passed away 6 months later, the insurer could contest the claim. Understanding this 2-year window is key to how insurers manage initial policy risks. Question 3. Which of the following statements about variable life insurance policies is true in California? A. The policy owner bears the investment risk. B. The cash value is guaranteed. C. They do not require a securities license to sell. D. Premiums are fixed and cannot be adjusted. Answer: A. The policy owner bears the investment risk. Variable life insurance policies allow the policy owner to direct the investment of cash values into a separate account, typically comprised of various sub-accounts similar to mutual funds. Because the cash value and death benefit can fluctuate based on the performance of these underlying investments, the policy owner assumes the investment risk. This means that unlike whole life, where cash value growth is guaranteed, variable life offers potential for higher returns but also the risk of loss, requiring both a life insurance license and a securities license to sell. Always remember that variable implies investment risk for the policy owner. Question 4. In California, what is the primary purpose of the California Life and Health Insurance Guarantee Association, CLIGA? A. To regulate insurance companies and enforce market conduct rules. B. To protect policy owners, insureds, and beneficiaries against an insurer's insolvency, up to certain limits. C. To provide low-cost health insurance to uninsured Californians. D. To assist insurance agents in obtaining their licenses and continuing education. Answer: B. To protect policy owners, insureds, and beneficiaries against an insurer's insolvency, up to certain limits. The California Life and Health Insurance Guarantee Association, CLIGA, is a non-profit, unincorporated association of all admitted life and health insurers in California, established to protect consumers in the event an insurance company becomes insolvent, unable to pay its claims. When a member insurer is liquidated, CLIGA steps in to cover eligible claims up to statutory limits, such as $250,000 in cash values and $300,000 in death benefits. This acts as a safety net, similar to FDIC for banks, ensuring that policyholders are not left without protection if their insurer fails. Think of CLIGA as a vital safety net for policyholders. Question 5. An agent selling a life insurance policy in California must provide the applicant with a buyer's guide and a policy summary. When must these documents be presented? A. Only upon the applicant's request. B. At the time of policy delivery. C. Before accepting the initial premium. D. At or before the time of application. Answer: D. At or before the time of application. In California, the Department of Insurance requires agents to provide potential life insurance applicants with a buyer's guide and a policy summary at or before the time of application. The buyer's guide is a generic document explaining different types of life insurance and how to make informed decisions, while the policy summary provides specific details about the proposed policy, such as premiums, cash values, and death benefits. This ensures full disclosure and helps applicants understand the product before making a commitment. Providing these documents upfront empowers consumers to make educated choices. Question 6. What is the required grace period for a life insurance policy in California, if the policy owner fails to pay the premium by the due date? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. A grace period is a mandatory provision in life insurance policies that allows the policy owner additional time to pay a premium after its due date without the policy lapsing. In California, the grace period for a life insurance policy is a minimum of 30 days. This means that if a policy owner misses a payment, they have an extra month to catch up before the policy terminates, and the coverage remains in force during this period. For example, if a premium is due on January 1st and not paid, the policy would still be active until January 31st, providing a crucial safety net for policyholders. Always remember the 30-day grace period gives policyholders a buffer. Question 7. A life insurance policy's cash value is surrendered, and the policy owner chooses to receive the proceeds as a lump sum. How are these proceeds typically taxed in California? A. The entire lump sum is taxable as ordinary income. B. Only the amount exceeding the premiums paid into the policy is taxable as ordinary income. C. The lump sum is tax-free up to the policy's death benefit. D. The lump sum is taxed as a capital gain. Answer: B. Only the amount exceeding the premiums paid into the policy is taxable as ordinary income. When a life insurance policy's cash value is surrendered for a lump sum, only the gain, which is the amount received that exceeds the total premiums paid into the policy, cost basis, is considered taxable income. This gain is taxed as ordinary income, not capital gains. For example, if a policy owner paid $20,000 in premiums and surrendered the policy for $25,000, only the $5,000 gain would be taxable. This tax treatment encourages policyholders to view life insurance as a long-term protection tool rather than a short-term investment. Question 8. In California, if a life insurance applicant tests positive for HIV, what action may the insurer take? A. The insurer must issue the policy at standard rates. B. The insurer must deny coverage based solely on the positive test result. C. The insurer may decline coverage, offer coverage with an exclusion, or rate up the policy, provided the decision is based on sound underwriting principles and not unfair discrimination. D. The insurer can only decline coverage if the applicant also has AIDS. Answer: C. The insurer may decline coverage, offer coverage with an exclusion, or rate up the policy, provided the decision is based on sound underwriting principles and not unfair discrimination. California law allows insurers to use HIV test results in underwriting life insurance applications, but it strictly prohibits unfair discrimination. If an applicant tests positive for HIV, the insurer can make an underwriting decision that is consistent with generally accepted actuarial principles and based on the risk of mortality. This might include declining coverage, offering coverage with a specific exclusion, or rating up the premium to reflect the increased risk. It's crucial that any action taken is supported by data and not solely based on the positive test, ensuring fair treatment. Insurers must apply sound underwriting principles, not prejudice. Question 9. Which of the following is considered an unfair trade practice in California related to life insurance sales? A. Offering a policy with a guaranteed interest rate. B. Providing an accurate illustration of policy values. C. Replacing an existing policy without clearly disclosing all advantages and disadvantages. D. Requiring an applicant to undergo a medical exam. Answer: C. Replacing an existing policy without clearly disclosing all advantages and disadvantages. Replacing an existing life insurance policy with a new one without providing full and clear disclosure of all potential advantages and disadvantages is known as replacement, and is heavily regulated in California. This is an unfair trade practice because it can often be detrimental to the policy owner, leading to new surrender charges, loss of accumulated cash value, or higher premiums due to older age. Agents are required to follow strict procedures, including providing a notice regarding replacement to ensure the policy owner makes an informed decision. Always prioritize the client's best interest and ensure full transparency, especially in replacement situations. Question 10. A policy owner in California wants to ensure that if she becomes totally disabled, her life insurance premiums will be paid by the insurer. Which rider should she add to her policy? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Waiver of premium rider. D. Cost of living rider. Answer: C. Waiver of premium rider. The waiver of premium rider is a valuable addition to a life insurance policy that protects the policy owner in the event of total and permanent disability. If the insured becomes totally disabled, this rider waives the payment of premiums, meaning the insurer continues to pay them on behalf of the policy owner, and the policy remains in force with its cash value growing. For example, if someone is diagnosed with a disabling condition, this rider ensures they don't lose their coverage due to an inability to work and pay premiums. This rider provides crucial financial security during a difficult time. Question 11. What is the primary characteristic that differentiates a whole life policy from a term life policy in California? A. Whole life policies offer a lower death benefit. B. Term life policies accrue cash value. C. Whole life policies provide coverage for the entire life of the insured, while term life policies provide coverage for a specific period. D. Term life policies are always more expensive than whole life policies. Answer: C. Whole life policies provide coverage for the entire life of the insured, while term life policies provide coverage for a specific period. The fundamental difference between whole life and term life insurance lies in the duration of coverage. Whole life insurance is designed to provide coverage for the entire life of the insured, as long as premiums are paid, and also builds cash value that can be accessed during the insured's lifetime. In contrast, term life insurance provides coverage only for a specific period, such as 10, 20, or 30 years, and typically does not build cash value. Think of whole life as permanent protection and term life as temporary protection for a defined need. Question 12. A life insurance policy in California includes a suicide clause. What does this clause typically state? A. The policy will pay the full death benefit if the insured commits suicide at any time. B. The policy will pay the full death benefit if the insured commits suicide after a certain period, usually 2 years from the issue date. C. The policy will never pay a death benefit if the insured commits suicide. D. The policy will only pay the cash value if the insured commits suicide. Answer: B. The policy will pay the full death benefit if the insured commits suicide after a certain period, usually 2 years from the issue date. The suicide clause is a standard provision in life insurance policies designed to protect insurers from adverse selection, where someone might purchase a policy with the intent to commit suicide. In California, if the insured commits suicide within a specific period, typically 2 years from the policy's issue date, the insurer will usually only return the premiums paid, not the full death benefit. However, if the suicide occurs after this 2-year contestable period, the full death benefit will be paid. This clause balances consumer protection with insurer risk management. Question 13. Which type of life insurance policy offers flexible premiums and an adjustable death benefit, along with a cash value account that grows based on a declared interest rate by the insurer? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a flexible type of permanent life insurance that offers adjustable premiums and an adjustable death benefit, allowing the policy owner to increase or decrease payments and coverage amount within certain limits. It also accumulates cash value which grows based on a declared interest rate by the insurer, making it distinct from variable life where cash value depends on investment performance. This flexibility allows policy owners to adapt their policy to changing financial needs, such as skipping a premium payment as long as there is sufficient cash value to cover policy charges. Universal life is known for its adaptable structure. Question 14. An agent is replacing an existing life insurance policy with a new one for a client in California. Which of the following is true regarding the agent's responsibilities? A. The agent only needs to notify the client's existing insurer. B. The agent must provide the client with a notice regarding replacement and submit it to the replacing insurer. C. The agent is not required to disclose any information if the new policy is more beneficial. D. The agent must obtain a signed waiver from the client acknowledging the replacement. Answer: B. The agent must provide the client with a notice regarding replacement and submit it to the replacing insurer. California regulations regarding life insurance replacement are stringent to protect consumers from potentially harmful changes. When an agent proposes replacing an existing policy, they are legally required to provide the applicant with a notice regarding replacement at the time of application. This notice must be signed by both the agent and the applicant, and a copy must be submitted to the replacing insurer, which then notifies the existing insurer. This process ensures full disclosure and allows both insurers to review the transaction for the client's best interest. Always follow strict replacement procedures to protect your client and yourself. Question 15. In California, what is the maximum free look period for a life insurance policy sold to an individual age 60 or older? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: C. 30 days. While the standard free look period for most life insurance policies in California is a minimum of 10 days, policies sold to seniors, defined as individuals aged 60 or older, must provide an extended free look period of 30 days. This extended period offers older applicants more time to review their policies and ensure they meet their needs, acknowledging that senior consumers may require additional consideration. This consumer protection ensures ample time for review for those who might need it most. Question 16. What is the main purpose of an annuity suitability standard in California? A. To ensure all annuities offer a guaranteed rate of return. B. To prevent agents from selling annuities to clients who do not need them. C. To ensure that the recommended annuity product is appropriate for the consumer's financial situation and objectives. D. To guarantee that an annuity will outperform other investment options. Answer: C. To ensure that the recommended annuity product is appropriate for the consumer's financial situation and objectives. Annuity suitability standards in California require agents to have a reasonable basis for believing that a recommended annuity transaction is suitable for the consumer, based on their financial situation, insurance needs, and investment objectives. This means conducting due diligence, gathering relevant client information, and recommending a product that genuinely aligns with the client's goals, such as income and retirement, rather than just making a sale. For example, selling a long-term surrender-charged annuity to an elderly client with immediate liquidity needs would be unsuitable. Always prioritize the client's actual needs and financial situation. Question 17. Which of the following is typically not a characteristic of group life insurance in California? A. Coverage is usually provided without individual medical underwriting. B. The employer is typically the policy owner. C. Individual policy contracts are issued to each employee. D. Premiums are often lower than comparable individual policies. Answer: C. Individual policy contracts are issued to each employee. Group life insurance is typically issued under a single master policy to an employer, association, or other eligible group, not individual policy contracts to each member. Each individual covered under the group policy receives a certificate of insurance, which summarizes their coverage, rather than a full policy. A key advantage is that coverage is usually provided without individual medical underwriting, evidence of insurability, making it accessible to many, and premiums are generally lower due to the larger risk pool. Remember, a single master policy covers the group, not individual contracts. Question 18. An applicant for a life insurance policy in California misstates their age on the application. What action will the insurer likely take upon discovering this misstatement, especially if the policy has been in force for several years? A. The policy will be voided, and all premiums returned. B. The death benefit will be adjusted to what the premiums would have purchased at the correct age. C. The policy will lapse immediately. D. The insurer will charge an additional premium to make up for the difference. Answer: B. The death benefit will be adjusted to what the premiums would have purchased at the correct age. The misstatement of age or sex provision is a standard clause in life insurance policies that addresses situations where an applicant provides incorrect age or gender information. Rather than voiding the policy, which would be unfair, the insurer will adjust the death benefit to the amount that the premiums paid would have purchased at the insured's correct age and gender. For example, if someone understated their age, the death benefit would be reduced because they paid less premium than they should have for their actual age. This ensures fairness for both the insurer and the policy owner without terminating valid coverage. Question 19. What does the term churning refer to in the context of life insurance in California? A. Illegally exchanging policies for cash value. B. Replacing an existing life insurance policy with a new one issued by the same insurer, primarily to generate new commissions without a reasonable benefit to the policy owner. C. Encouraging a policy owner to borrow against their cash value. D. The process of an insurer converting a term policy to a whole life policy. Answer: B. Replacing an existing life insurance policy with a new one issued by the same insurer, primarily to generate new commissions without a reasonable benefit to the policy owner. Churning is an unethical and illegal practice in California where an agent persuades a policy owner to replace an existing life insurance policy with a new one issued by the same insurer, primarily to generate new commissions for the agent. This is distinct from twisting, which involves replacing a policy with one from a different insurer. Churning is detrimental to the policy owner because it often incurs new surrender charges, restarting the contestable period, and providing no actual improvement in coverage or benefits. Agents must always prioritize the client's financial well-being over personal gain. Question 20. When a life insurance policy is issued in California, which of the following is typically not required to be included in the policy's face? A. The names of the parties to the contract. B. A statement of the premium. C. A copy of the application. D. A description of the coverage provided. Answer: C. A copy of the application. While the application is a vital part of the insurance contract and often attached to the policy, California law specifically states that the policy's face, the declarations page, must contain the names of the parties to the contract, the policy's term, a statement of the premium, and a description of the coverage provided. The application itself, though incorporated by reference and attached, is not typically printed on the very front of the policy document itself. The face of the policy provides immediate key summary information. Question 21. Which type of annuity begins making payments immediately after the first premium is paid and is designed to provide immediate income? A. Flexible premium deferred annuity. B. Single premium deferred annuity. C. Single premium immediate annuity, SPA. D. Variable annuity. Answer: C. Single premium immediate annuity, SPIA. A single premium immediate annuity, SPIA, is designed for individuals who want to convert a lump sum of money into a guaranteed stream of income that begins immediately, typically within one payment period after the initial single premium is paid. This is often used by retirees who have a sum of money and want to ensure a steady income stream for a set period or for life. Unlike deferred annuities, there's no accumulation period, the income stream starts right away. Remember, immediate in SPIA refers to when payments begin. Question 22. According to California law, what is required for an agent to be able to sell variable life insurance products? A. Only a California life-only agent license. B. A California life-only agent license and a FINRA Series 6 or 7 securities license. C. A California property and casualty license. D. No special license is required if the agent works for a registered broker-dealer. Answer: B. A California life-only agent license and a FINRA Series 6 or 7 securities license. Variable life insurance policies are considered both insurance products and securities because their cash values are invested in separate accounts that fluctuate based on market performance. Due to this investment component, an agent selling variable life products in California must hold both a valid California life-only agent license issued by the Department of Insurance and an appropriate securities license, such as a FINRA Series 6, Investment Company and Variable Contracts Products Representative, or Series 7, General Securities Representative, license. This dual licensing ensures the agent is qualified to explain both the insurance and investment aspects. Remember, variable means dual licensing. Question 23. A life insurance policy in California has a rider that provides an additional death benefit if the insured dies as a direct result of an accident. What is this rider called? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit, ADB, rider. D. Cost of living rider. Answer: C. Accidental death benefit, ADB, rider. The accidental death benefit, ADB, rider, often referred to as double indemnity, provides an additional death benefit to the beneficiary if the insured's death is the direct result of an accident, meeting specific criteria outlined in the policy. For example, if a policy has a $100,000 death benefit and a $100,000 ADB rider, the beneficiary would receive $200,000 if the insured dies from a covered accident. This rider specifically enhances coverage for accidental fatalities, not deaths from illness or natural causes. This rider is designed for those seeking extra protection against tragic, unforeseen events. Question 24. What is the primary purpose of the Notice Regarding Replacement form in California life insurance transactions? A. To inform the new insurer that a policy is being replaced. B. To allow the replacing agent to collect additional commission. C. To ensure the policy owner is fully informed of the potential advantages and disadvantages of replacing an existing policy. D. To notify the California Department of Insurance that a new policy has been issued. Answer: C. To ensure the policy owner is fully informed of the potential advantages and disadvantages of replacing an existing policy. The Notice Regarding Replacement form is a crucial regulatory document in California designed to protect consumers by ensuring they are fully aware of the implications of replacing an existing life insurance policy. It requires the agent to disclose all potential negative consequences, such as new surrender charges, loss of accumulated cash value, or a new contestable period, enabling the policy owner to make an informed decision. This form serves as a critical safeguard against predatory replacement practices. Its main goal is consumer protection through transparency. Question 25. Which settlement option in a life insurance policy pays the beneficiary a guaranteed income for a stated period, regardless of whether the beneficiary is still alive? A. Interest only. B. Fixed amount installments. C. Fixed period installments. D. Life income. Answer: C. Fixed period installments. The fixed period installments, or period certain, settlement option pays the death benefit over a specified number of years in equal installments. If the beneficiary dies before all installments have been paid, the remaining payments are guaranteed to be paid to a contingent beneficiary. This option guarantees payments for a specific duration, providing a predictable income stream for a set time frame. For example, if a beneficiary chooses 10 years of payments, they are guaranteed to receive those payments for the full decade.